I like the way Brian Chapata, our Bloomberg opinion columnist, put it today. He said that Jay Powell's testimony was not a hint of a July rate cut, it was a declaration. If that's the case, what happens after the July 31st rate cut? How does the Fed proceed from there?
Yeah, so I think that what's firstly important to keep in mind is whether or not the Fed looks to cut 25 basis points or 50 basis points in July. The market had already priced in that they were coming into today, that it was likely that they were going to price 25 basis points a cut in July. The market has now moved to pricing almost a 1/3 chance of a 50 basis point cut in July as well. So we've seen a pretty significant sort of reversal in terms of Fed rate expectations in the July meeting. Going forward, the question for the market really in terms of the sustainability of these moves that we're seeing is this a one-time insurance cut or is it going to be a more sustained cut going forward? Are we likely at the onset of a rate cutting cycle? And that I think is a big question mark that the market has to come to grapple with. I think a lot is going to, be keyed into, and the market is really going to be clued into how the Fed positions and how Jay Powell positions the cut at the July meeting. Because when you look at the after effects of how markets trade post first Fed cut, what really matters is this an insurance cut or is this a sustained move lower? If it's a sustained move lower, then we're going to see, I think, the curve steepen fairly significantly from here. We could start to see the dollar really roll over and become more of a funding currency for markets, and clearly it would be a bullish environment for equities.
All right, so Erin, based on that and based on that question, Mark, does it still make sense to be exposed to Treasuries right now?
So in my view, I think yes. I think that being long Treasuries, you're earning 2%. It doesn't seem like a high number, but when you look across the globe, you have both Japan and Germany and European yields in negative territory. The U.S. is sort of the best of where you could get yield on a global basis. So I think it's for portfolios that are a little bit equities, a little bit fixed income. It still makes sense to be long fixed income, particularly U.S. yield in your portfolios.
All right, so the appeal of Treasuries, particularly compared to those overseas, means that there will still be demand for those securities, which will push yields lower. What does that mean then for the dollar? Because we know that the president is more concerned about the dollar now at this point, given that the Federal Reserve has signaled it is in position to cut rates.
Right, so the strength of the dollar year to date, or really over the last couple of years, has really been driven by the fact that the U.S. is outperforming relative to the rest of the world. So the dollar strength has made sense just looking at economics. The question going forward is we have seen the U.S. sort of converge downwards to the rest of the world to some extent, but the U.S. is still outpacing growth globally. So going forward, if the Fed is embarking on the start of a rate cutting cycle, then you are going to see a sustained move lower in the dollar vis-a-vis euro and potentially yen as well, but particularly versus the euro. When we've looked historically at past precedent, when the Fed just does a rate insurance cut, typically you see the dollar sell off a little bit, but then stabilize in the month afterwards. When you start to see the start of a rate cutting cycle, that's when you see a more sustained move lower that's protracted in the dollar. So getting back to your earlier question, what the Fed indicates with regards to future rate cuts at the July 31st meeting is going to matter a lot for how much lower the dollar can actually move and if it can really break below this range that we've been trading in over the last 6 months or so.
So Erin, when you look at risk assets, you look at the equity market and other risk assets out there, do you actually think that right now a Fed cut, whether it's 25, 50, whatever, that's going to be enough alone to support further appreciation in those risk assets? Do we have the economic fundamentals? Do we have the earnings fundamentals to also support that?
You have seen a divergence, I think, in the last few months with regards to what the macro fundamentals are telling you, which is weaker, and what S&P is telling you or equity markets are telling you globally, which is stronger growth. And so that divergence, I think, is going to be sussed out and really is going to be grappled with over the next couple of months within the markets. Right now, I think a lot of the move and a lot of the sort of a sustained move higher in the S&P as an index year to date has been driven by the tech sector, and that's really decoupled from some of the macro fundamentals that you're seeing. But when you look sort of under the hood at what the market's telling you, the underlying drivers, the underlying sort of movers in the market are not nearly as robust or optimistic a story as what's, I think you see on an aggregate index level. 25 basis points, I think the market is telling you today, look at the Russell relative to the S&P, it's underperforming. Look at some of the deep cyclical sectors like industrials, like metals and mining, like consumer cyclicals. They're underperforming. They're actually down on the day relative to the S&P 500. So what the market's telling you is that a 25 basis point cut or even a 50 basis point cut isn't going to revamp global growth. It's not going to, get investment spending higher.
Right.
It's going to sustain, sort of the moves that we've seen this year, and maybe you see continued appreciation and outperformance of the high growth secular growth stories like tech, but it's likely not going to lead to a sustained, sort of revamping of global growth, and certainly even U.S. growth.